not all investors are created equally, right? Some are more focused on yield, some like a hybrid yield and capital appreciation. Others are happy to sort of swing for the fence and say, I'm okay if this turns out to be a zero investment for me. I want a chance of making kind of like 20x my money.
Representing Franchise Secrets, Eric Von Horn.
Welcome back to the show, Adam. You look the same. The exact same.
I feel the same.
All right. We finished up the last podcast and we were talking about upside potential with investors and de-risking, the de-risking aspect of bringing on investors. What I want to talk about today is somebody's ready to buy. Ready to bring on an investor. They've got the right investor. They have the right reasons to bring on an investor. What does a deal look like with an investor on the franchisor side? And as we talk about this throughout this whole episode, we will be weaving in franchisee, franchisor. But from the franchisor lens, they're ready. Like, what's next? What does a deal look like?
Okay, and we're fast forwarding through the stage where they put some materials together and gone out and sort of courted investors, met
Dude,
folks.
I knew we were going to go back on something, Adam. Yeah, I'm always like a step or two ahead of where I should be. You're really good at reeling me back in. Like, oh, that was a very nice way of saying, Eric, you skipped some very important steps. Very nice of you to say that. Adam, have I missed any important steps between then and now? Tell us the important steps that I missed.
Well, no, I guess I'm just like saying that if there's listeners out there where they're like, actually, I think it is interesting in terms of, is there the right investor out there for me? And I'm feeling a little overwhelmed in terms of like, how do I go about that? Right? This all makes sense. So what do I do? And I think my answer to that is just based on everything we've been speaking about, some of like the internal exercise that folks have done in terms of, this is what my business could look like, with a partner, with an investor. What the next step to do is to bring all these materials together in, generally a 15 to 20 page investor presentation. And there's a lot of good like templates out there online, but what it usually is, I think at the highest level, is it summarizes to an investor, sort of like the background, where the idea came from, and kind of like where you are today. What are the right key milestones across the business? Importantly, what's the purpose? What's the mission of the brand? Where do you see the business going over the next 5 years? And, as a result of that, what are you looking for in a partner? And I think it's really important to look at that through two lenses. One is like, what is the capital? What is the money I need? And then B is like, where are there skill gaps across the organization that I could benefit from the expertise of an investor as well? Because like, yes, you need the capital, but I think you also want some expertise and thought stewardship around them helping you to, create that foundation sooner that we've been talking about. And I think that's like really important because it's, that can take a bit of time in terms of sort of like crispening up and, having a clear point of view in terms of, hey, this is why we're really excited and this is what we're looking for. And, then there's the process of actually like getting out to meet investors, and that can feel quite intimidating. It can be quite overwhelming. What I usually do as a first step is do a whole bunch of market research when there's other brands and businesses out there that I think are useful, relevant analogies to what I'm building. Do a bit of poking around in terms of like, did they get investors? If so, who? That's usually the first calling card in terms of folks that I reach out to. But it's a really interesting process going through that, Eric. As I said a little cynically, it, a good time to do it is when you don't necessarily have a gun to your head and you need cash in the next few weeks. But the process of meeting and talking to investors, I actually find like really, it's an incredibly helpful exercise. I think at times it can be very humbling. It can be very disheartening if have investors say, "Hey, nothing personal, but we're not going to invest in your concepts." My counter is, well, this is highly personal because it is my concept. But you get feedback from investors on, hey, this is what we like, this is what we don't like, and if it's not for us right now, here are the data points that you're going to need to prove out in order for us to want to invest in you. So you get it's always it's helpful because as a franchisor or franchisee, you're so in the weeds and in the business, and it's always a helpful frame from someone outside looking into through an investor lens, give you pointed feedback on, hey, this is what we think we need to see to make this kind of like investment worthy for us. But as you're talking about it, you may have investors that say, actually, this is really interesting and this is right in our sweet spot. So like, let's talk about it. And I find usually that's the basis where I share the financial plan that I've done. I ask them for feedback. I ask what they like, what they don't like. And you almost like start iterating together. And that to my mind is actually the first really good litmus test in terms of, hey, can I imagine myself like working around the table with this person, right? Are we going to be additive here in a way where 1 + 1 = a whole lot more than 2? And again, I think that can be, bit of a process where you may need to kiss a few frogs before you find your prince or princess. And it does take you away from running your business. I don't want to diminish that point, but again, like when we're talking about what is potentially a really important investment decision that you're going to be making, sort of like a marriage to some extent, right? If this is going to be a partner that's going to be with me for the next 5 to 8 years through to a sale of the business, you really want to be doing your diligence to make sure that this is a partner that we can really work together with. So I don't know if there's anything that I need to dive a little deeper in, but that to my mind almost brings us back to where we are on your question on, okay, we've done a few steps here. We've met some folks. We've now actually found a partner that we really like and feel like, hey, we want to take this to the next level and get into sort of like brass tacks in terms of like, what does an investment look like and what's the right way to structure it?
Okay, before you get to what does the investment look like and what's the right way to structure it, I want to bring up 2 points. One, you get the document, the paperwork, like, you did the research and now you have something to show investors. Don't just go on Facebook and say, hey, I'm looking for investors. Here's everything about the investment, message me if you want to invest. You could get in trouble with the SEC for doing such things. You really need to understand what you can and can't do, who you can talk to, how you go about getting interested investors into your deal. Is that any comments on that besides like talk to an attorney, do some research, don't blast it out there on Facebook that you now have an investment opportunity for the world to see. Message me.
Yeah, that's a great point. And, lawyers will inevitably give you some overly long disclaimer that you'll insert in that presentation that obviously talks about the fact that, it contains assumptions and forward-looking statements and whatnot. So yes, I think getting them to sort of like bless it and make sure that sort of dotting I's and crossing T's, absolutely. And I think when you've also got materials there, and I think we've all been on the receiving end of solicitation by others, in our lifetime. I'm always a fan of like where you can actually like reach out and again, sort of like through LinkedIn and the world we live in these days, there's so many different ways to do it, but where you can actually get the right personal introduction to the person that you want to be speaking to. Because I think it's always like the quality, and I know on my end, if investment opportunities, blindly just sort of come to me, sort of pushed out on a LinkedIn post versus coming in thoughtfully through a trusted connection, I'm far more inclined to like listen to my trusted connection and like look at the business. So I think it can be, when you feel great about your materials, the worst thing you want to do is just sort of like blast it out there, via a megaphone. You want to be thoughtful, and quality always rules the day over quantity.
One last thing before we get into like deal structures is you made an important point. Like you're going to get told no a lot, and doesn't mean it's a bad deal. So from your end as the franchisor, you're thinking this is the least risky investment in the world because this thing is going to go to the moon, and I'm giving you way more than you deserve as an investor. And that is your lens. From an investor's lens, they're probably viewing this as an angel investment or maybe as an venture investment, not as a low risk deal. So most investors that have any type of significant portfolio or building a portfolio have, a lower allocation towards angel or venture deals. And if they do, they know they have some allocations going to be maybe 5%, maybe 10%, but it's not going to be high. So it might be a great deal, but a sophisticated investor will say, no, I've kind of over allocated in this particular like set of investments in my portfolio. So you're going to get told no a lot, doesn't necessarily mean it's a bad deal. So when you're talking to like more sophisticated investors, learn from them. If it's a no, learn from that person. Understand, don't get defensive or don't get mad that they said no. So it's a really great opportunity. And if they say no, is I'm just over allocated in this. That is a great one to lean into. As I talk to other people, help me help me with my presentation. What are you looking at in this deal that I don't see? So I think that, just in terms of learning from people that say no, like that's probably a smart way to do it. But anything along those lines, venture, angel, am I on track there, Adam? Anything to
Yeah,
add?
no, absolutely. And I think it goes to something we were talking about in an earlier discussion, Eric, around the fact that like not all investors are created equally, right? Some are more focused on yield, some like a hybrid yield and capital appreciation. Others are happy to sort of swing for the fence and say, I'm okay if this turns out to be a zero investment for me. I want a chance of making kind of like 20x my money. So like and they're all different, but you're right. When you do get the no, which will happen, I'll sort of tell you a funny story on that in a second. It's always good to to learn and ask questions, like be curious, like how do you think about underwriting an investment? What sort of return thresholds do you look for? How do you think about risk? Talk me through some of your more successful investments, talk me through others that haven't worked and why. And again, like the right investors actually, knowing they don't get asked those questions that often, I think they're actually going to be very generous with their time because they're going to want you to succeed. So, use this sort of like 15-minute of question asking it's going to be a treasure trove of intel you're going to get.
And it might not be, they might, on the second time that you need some investment, that person that said no the first time is going to keep that deck that you gave them, look at it. And then if it comes time for a second investment, another round, then that might be the person that invests in that. It might be the right deal for them. It might be the right time for them. So that's great. What else? Anything else there, Adam, or should we get to like the actual deal?
No, just a funny little story of a
Story.
founder once who he sort of came back and was giving me a recap of another rejection that he'd gotten, and he was quite excited about it. And I was like, talk me through this. And he said, well, like rule of thumb I've been told, or as I've read up on it, is for every 1 yes, I'm going to be getting like 9 no's. So it's like the faster I speed up and get through my no's is the sooner I'm going to be getting to my next yes. So this is progress. And I thought that was actually such an endearing, positive way to look at it.
I have one little story too. So I have a friend in franchising, very successful in franchising. And I was with him talking about this type of stuff. And he's like, yeah, I have an allocation that's for franchising, like angel franchising deals, new franchisors or whatever. He's like, That's what he called it, like my angel franchising investment part of his portfolio. He said, my wife calls it my charity. It's like she knows it's not going to come back. So it's he sees it as his franchise or investment. And his wife looks at it as his giving back to early stage franchisors, because he doesn't get that money back most of the time. He'll win every now and then, but I think a lot of people probably want an introduction to him. I'm not going to give out his name. It's not Adam Ross. I do know that.
Attention, franchisors and franchisees. There are two really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my Franchisee Mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com.
All right, Adam. So I think back to my original question, you took us on a 15-minute tangent. Thanks for doing that. Really appreciate that long tangent. Now let's get into the good stuff, man. The deals. Like, talk to me about deals. That's what everybody's been waiting for 3 episodes. What does a deal structure look like? Or do we have to go back some more?
No. I think we're at a good place where we've had a few sessions with a potential investor. They're very interested in investing. We're very interested either as a franchisor or franchisee as, in terms of partnering with them. Right. So what's next? And, these things can work, I think, ultimately sort of like one of two ways. One is as the person receiving the investment, we would then sort of like share with them, kind of like, here's what we think the value of our business is today. Here's how much capital we think we need. And here is here is one thought, or here are sort of 2 thoughts on how this investment could be structured. And we'll get into that in a second. The other approach is, some investors, ball can be, in their court on, and we say either as the franchisor or franchisee, okay, you've seen our financials, you've seen our plan, you've had time with us. We would actually love to hear from you what you think the business is worth, and, what sort of terms and structure you would like to, you'd be interested in investing with us. I'm generally a fan of the latter. I think, why disclose your cards first unless you need to? So generally, so whether it's one or the other, I think, to answer your point, and just for everyone listening out there is no such thing as like one structure, and that's, I hope that doesn't disappoint people. I think a way to always like to think about it is, and I think this comes to like just general structure and like negotiating in general, is I've had people that I've negotiated with, and they just counter, and it feels like they're just like arguing for the sake of, arguing and plucking numbers out of the air. I think if you've done the homework on, hey, this is what we think our financials look like for the next 5 years, and again, there's always assumptions that go into that. Here's a range of like multiples that we could sell the business for in 5 years' time. Here's the cumulative cash that we feel could be generated in, call it years 4 or 5 as a franchisor, or years 2, 3, 4, 5 as a franchisee. And you basically, look at like, here's the value creation that we feel can be created by us working together. And then I think, depending on like the investor and depending on like the risk tolerance of the of the franchisor or franchisee, it then comes down to, okay, so how do we slice this pie? And, a simple one can be, we think that you should get, X% of the business. And it's a very simple, that's how it's going to be structured. There can be other ways where, again, depending on like the risk tolerance of the investor, it could be one where they're actually happy to take a smaller percentage of the business, but they get a guaranteed return as first of that. So, that could be an example where, investors could get a 15% return on their money, and that gets paid first before there's some sort of like breakdown of distribution of proceeds based on ownership.
So it's not a guarantee that they're going to get it. It's a guarantee that they're going to get it before other people get it, right? I mean, if the business folds, nobody's getting it, but they're going to get it. They're in line to get it sooner than other people.
Correct. And I think that can be, and again, it will sort of like depend on the investor, Eric. And I'm giving an example of where there's a, sort of like an annual yield-based return. I mean, there's other concepts where some investors say, like, whatever capital I put into the business, I want to make sure that that entire amount gets returned to me before we then sort of like distribute proceeds based on ownership. And again, people will be willing to have different levels of ownership based on, again, I think like where there's different levels of like protection for them. And, again, for the, putting myself back in either the franchisor or the franchisee's shoes, if like, you're the ones that are giving up equity, it's not to, I think the best deals are ones where you can actually create like alignment. And I sort of think about that in terms of, how do you incentivize a key hire in the business? I think the more you can actually create alignment where they can make more money in a way that you can make more money, they're generally sort of like the best deals. So I'm not advocating here that this is one where, you're just out to acquiesce to everything like the investor says, but I found it's actually it's easier to work through structure when I've asked them questions in terms of like what is important to them. So I can then just like be thoughtful in my response, which isn't just, hey, I disagree with what you're saying, I'm going to counter with, you said X, I say Y. I find it helpful to say, you said X, I'm now proposing Y, and I'm doing this based on what I've heard you say in terms of what's important to you. And I'm saying this like in terms of what's important to me. This is why I think it's good for the brand and why I think this balances like risk and return for each of us. So I say that because I think that's like a really core philosophical approach to, I think, how you structure. And I've seen so many ways of like doing it the wrong way, Eric, where it's tone deaf, it's back and forth on email, there's no context. I actually find if you actually sort of like talk through it and you hear what is important, you can create the right sort of like upsides and downside protections in a way that, most of the deals that I've structured, and I've done far too many capital raises than I'd like to admit over various businesses over the last 20 years. Not a single one of them has been the same structure. There's been nuances, but that's been important because I don't find there's a one size fits all approach to this.
If there was a one size fits all approach, what would it be? What are the top two?
I would say if there was going to be a more common vanilla structure, Eric, I'd say it would be one where an investor would invest in again, franchisor or franchisee, it doesn't matter here, and they would invest where they would get preferred equity. And generally the founder of the business has common equity. So what that would mean is, and I'm going to use sort of like round numbers here to illustrate the point. But if we said that we had a business that, let's call it like $8 million of value, an investor is going to invest $2 million into the company, that means the value of the company is now worth $10 million. Investor has 20%. So if in the structure of where they have 20% and their preferred equity and the founder has 80% equity and that's common, what would happen is, let's just say for whatever reason, the company didn't work out and, you could sell it down the road for $2 million. That would mean, because that investor has preferred equity, that means all the $2 million from those proceeds would go to the investor. Now, if you're going to sell the business for $4 million, basically sort of like 2 million of that would go first to the preferred investor, and then you'd have an 80%, 20% split on the remaining $2 million. The business sells for 20, 30, 40 million and it's a success, then it's a bit of a moot point. The point being though that structure and sort of having a preference above that of a common shareholder gives investors some protection in a downside scenario.
What if it sells for exactly $0?
No one gets anything.
No one gets anything. And this goes back to the risk. Like there's risk for the investor. Like they get zero. They put up all the money. You probably put up very little money, and they lose all that money. If you were to go to the bank where they tied it to your house or different assets, because that's what they do, like you're on the hook for that $2 million. Think about this as a franchisee. Most franchisees have to sign, personal guarantees on the money that they raise from a bank, or dealing with landlords. They have to personally guarantee the leases that they're on. And if they had the investor that was signing off on, certain things, that the investor would be the one that would sign the personal guarantee on the lease. I mean, they could. This isn't like this would happen, but this illustrates the point of the de-risking that we were talking about on the last episode. So there's different ways to look at de-risking it, but the investor's looking at risk, and many people probably they're not looking at the risk that the investor's actually taking. But I think I would encourage you to kind of look at it as a franchisee and franchisor through that landlord type personal guarantee. Like there's real risk for you putting up the capital, guaranteeing different things, whereas the investor has real risk. And the more risk that they take, the less risk that you take in many ways, because their money's on the line. I just wanted to kind of bring that up when we talk about, because we're talking about
and I think that's such a great point when you are looking to structure the right deal, Eric, because I think you get to the right place when you're putting yourself in like your counterpart's shoes as well.
Yep. So that's preferred equity. There's many different ways to structure that, and that's where, do you think if you had to look at a base of the investments that you've done or capital raises that you've done, is that the base structure of it is preferred equity? Is that why you kind of said if there had to be a vanilla, investment type of structure, it's preferred equity? Is that kind of where you start when you're looking at it, or where most of your investment?
Yeah, I think so. I mean, in the last few years, we've seen a bit more of an increasing trend towards, structuring deals as, kind of convertible notes, or there's an industry term, SAFE notes, and SAFE is an acronym for, I think it's like sort of simple agreement for future equity.
Hit SAFE. I'm not going to interrupt you. Go with SAFE because we only have 2 to 3 minutes left.
Yeah, no, that's fine. It's basically what it is it's basically it's an investment into the company that will be debt for a period of time, and then upon a certain date or milestone of the business in the future, Eric, that debt will convert to equity at some pre-agreed terms. In some cases, safe notes can be done when a company knows that it's going to be, it's early, it's high growth. There's going to be a likelihood that it's going to be raising capital again in the future. And, that's one where it's like, hey, it's too early to know like what this company is really worth. Like we feel like we're pulling a number out of a hat, so to speak. So like, let's avoid the valuation discussion altogether. And, people that invest now will do it. And then there'll be a nice discount to the value of the next round that right, that debt will convert into equity. So again, we're getting more and more standardization around investment agreements, which is great. Investors are getting a lot more comfortable with these notes. So what it does is, versus 10 years ago when there was, I think, a lot of individualized negotiating around like transaction structure and documentation, and the only ones that were really making money were the lawyers. Um, this can be a lot more simple with templated version. So I'd say almost like think about it like some standard real estate leases. We're now actually seeing that crossover into a lot of sort of like deal documentation. So a safe note is a good example of that.
Can you compare safe to convertible? Where is there some similarities, differences?
Yeah, I mean, I'd say if anything, it sort of mirrors it quite well, Eric. I'd say it's just being done. A safe note has done a much better job, and I think it's actually it came out through sort of like National like Venture Capital Association, and it's now got pre-agreed terms and structures and definitions that work for kind of like both sides of the table. Um, so I think convertible notes are all a lot more unique and highly individualized. So, I'd just say at the highest level, a safe is a much more structured, simplified, and standardized form of that. But same concept of it's debt for a period of time until a certain milestone or date in the future where it will convert into equity, but it will convert in a preferred equity. So we're still back in that, right? An investor will have preferred equity when it does convert, and that's going to sit in the capital stack above the common equity of the founder.
All right. So I think we're got to have you in the franchisor mastermind to talk to specific franchisors that are in my mastermind about things like this, to get specific with them. One last thing before I let you go. I have a big beef with you. Very, very disappointed. Like, you have a Front Street hat and you've been on the Franchise Secrets podcast and you're not even wearing a Front Street hat. So you're not allowed to come back on until you wear the swag.
You know what? I'll take that as constructive feedback and do better for next time.
Thanks, Adam. See you later.
Okay. Cheers, Eric.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.